Okay, thanks.
Yeah, all right.
Good morning, traders and clients. Welcome to our weekly webinar. Today we have quite a few things going on, so forgive us if we pick up the speed a little bit. Apart from the market outlook, we're going to be talking about Garmin, Genworth, and Xeon today. Okay, for the contents for the market strategy, we'll be going through the list as follows. This list of 7 here: global growth, Singapore's growth, inflation, earnings, intermarket, technical, and then the conclusion. Global growth conditions continue to look up on the slides over here, which is this one: U.S. capital goods orders, European capital goods, and Japan machine orders. These 3 tend to be forward-looking. And you can see that there we have nice rebounds in Japan and the US, and for the European Union we have it trending nicely towards the positive line. Chinese industrial profit is not as bad as the media makes it out to be, because they don't smooth over trends but report month to month. But if you take it on a 3-month moving average, I think we're kind of hovering above in the expansion territory. And on the 12-month moving average, I think we are also seeing some stabilization. Singapore's growth outlook continues to inch positive. Non-oil domestic exports has been poor, however also getting less negative. If you look at the re-export side, we have a huge rebound, and that is actually taking gross exports to the positives level as well. So things are also looking up for Singapore. Okay, inflation globally is not really an issue. CPI is trending lower in most places. The US, Europe, Singapore CPI is also trending lower. Industrial Asia ex-Japan also trending lower. So we're in no hurry to start a rate-raising cycle yet. Okay, so for that's what we have been saying for the past few weeks already, that things are looking up, especially into the second half, and I think the latest macro data kind of confirms it. We've had this string of PMI numbers all over the place. So the main ones would be the US Manufacturing Index. I think put in a very good result at 55.4, over 50.9 the month before. Factory orders are at a new high. Non-farm payrolls was not fantastic, but acceptable at 162,000 jobs. And the Fed statement was still leaning towards the loose side, although we think that going into the end of the year, as data will probably be pretty strong, I think they will have to revisit this conclusion. And if we do start tapering, I think it'll be before the year is over. Now, the Eurozone also moved into expansion territory for the first time in 2 years, so that's really good news. Singapore's PMI was slightly better than the month before, however, it did beat expectations. China's services PMI rose 54.1 from 53.9, so also again an indication that China is stabilizing, not as bad as the market thinks. Okay, macro conditions are generally conducive for stocks. Global growth outlook is positive. Singapore's growth outlook is turning around. Inflation is very mild. There are some near-term macro risks on the horizon. Specifically, we have China's banking problems, and I think that's something that we'll have to continue to monitor. It's very hard to see through that situation because data is generally pretty opaque in that side. Tapering of QE, is it really bad? In our opinion, it actually signals a stronger U.S. economy, and that can't be bad for stocks. I mean, it might provoke a near-term sell-off, but I think underlying it means the environment's better for stocks than for bonds, because if the economy is improving, you're going to have some inflation, and that's bad. That's much worse for bonds than it is for stocks. Ongoing global problems is public sector deleveraging. So we might see the U.S. debt ceiling game of chicken again soon. What about earnings? We're generally positive on financials and telcos, industrials as well. I think Semarine will see some margin pressure, but the Keppel, Semco Industries, and ST Engineering have rather positive outlooks. ST Engineering especially has a record order book. The rest of the sectors are a little bit mixed to negative, and if you aggregate the whole lot, this line here is pretty important. That's the corporate earnings momentum sequentially, and as you can see, we have had a negative momentum, and that partly explains the corrections that we have had. However, we think that this probably looks more like a mid-cycle thing, as when you compare back to 2005 and 6. We also had a downdraft in earnings, which provoked some volatility, some heavy sell-offs before we had the massive run, and we think that's pretty much where we're at. We think that second half global growth is going to be picking up. I think Singapore will pick up as well, and earnings is likely to pick up too. Okay, I'll move you on to our technical analyst.
Okay, thanks Joshua for the economic outlook. Okay, so the technical analysis for this week, well, we have leadership for the S&P 500, which is encouraging. The latest surge up has been affirmed by a few key technical areas. One, we will find that consumer discretionary and industrial sectors hit new highs, and breadth and small cap and jobless claims all confirm the S&P move up. Because of time constraint, we will not be going through most of the Asian indices today, but the summary is that essentially most of the Asian indices are playing catch up. They are in an encouraging configuration and still on their long-term uptrends, except for the China market. Okay, as you can see for the S&P, we are still on an uptrend, and coupled with encouraging macroeconomic data, we are biased towards an uptrend in a larger time frame. Drilling deeper into the dailies, we see that last week price has indeed broken over the support zone over here, and we have stayed above it, and we actually have a bullish configuration. So we are actually up about 1% since last week. With the move above 1700 this week, well, we will now look at this support zone as well as the 1700 for the new support to watch. So a break under this support will probably trigger a short-term cycle downwards. However, any short-term cycle downwards should be seen as a buying opportunity, as a longer trend up move is still intact. Okay, when we look into the different sectors that contributed to the S&P going up for last week, we will see a couple of encouraging trends. These are 9 sector ETFs ranging from financials, industrials, technology, etc., etc. Each set of charts has 2 charts, top chart and the bottom chart. What's key is the bottom chart. The bottom chart, as you can see on the XLF, which is the financials, for example, is actually the relative strength performance of that sector ETF to the S&P, or in this case, the SPY. So if it's an uptrend here, it means that since May, for example, the financials have outperformed the S&P as a whole. Now, so what's interesting to note is that you see 4 charts here which have a green uptrend since May. So the financials, industrials, cyclicals have actually been outperforming the S&P since May. And this is encouraging because industrial cyclicals, financials, they are early to mid-cycle offensive sectors, and their strong relative performance affirm that the move in S&P is impulsive. Hence, short-term cycle downwards should be seen as a buying opportunity rather than the start of a bear market. Just specifically for the last 2 weeks, here's the relative performance of the sector ETFs versus the S&P. We see for the last 2 weeks, the biggest performers were cyclical technologies, followed by industrials and materials. Once again, these are offensive cyclical sectors, and this is encouraging. Breadth indicators also confirm the S&P move up, and the SUP ADP is essentially the advanced decline percentage line for number of stocks, and this is the percentage cumulative volume percentage line. So basically this shows that the number of actual stocks being bought has been going up, and the volume of being stocks has also gone up. So these two things are not the divergent of this S&P price line, which confirms the move up. Okay, another indicator. This is the S&P price. At the bottom here, you have the Russell 2000 relative strength to the S&P. What's important about this is that we see since May, the S&P has gone up, followed by quite a big correction, followed by a move up. But the important thing is that during this whole move, the Russell 2000 has actually been outperforming the S&P. Now, the Russell 2000 is made out of small caps. Small caps are much more sensitive to the economic cycle. Hence, this shows actual strength in the S&P move itself. That this corroborates the improving economic outlook. Okay, for Asian indices, in general, essentially most of the Asian indices are continuing the uptrends. They've all moved slightly higher, slightly less than 1%. We're going to skip through the individual indices because of time. We'll go straight to Singapore. Okay, so here's the STI weekly. Okay, so the update is still the same. We are still negotiating the resistance at 1260. We've bounced off at the resistance is at 3260, and we bounced off at 3259. Ever since, we've actually been consolidating underneath. It is encouraging that price did not totally bounce off the support and plunge downwards. It's actually consolidating, which is actually encouraging. So if you drill, just note that if there is a cycle down, that this blue zone over here provides a massive support zone. Okay, due to consolidation patterns here at the start of the year, all the way to of last year. Sorry, due to consolidation patterns at the start of 2012, as well as the end of the year, this provides great support. And this region is also the region of where a lot of Fibonacci ratios are actually present. That's if there is a leg down. This should be a great buying opportunity if it reaches that point. Going deeper, we can confirm whether there's a move up or down by looking at these two immediate support and resistance zones. So I would say that if the price can actually break this zone over here, 3277, then we are due for another leg up. But if we break this line over here, we might be due to cycle down. Okay, and that's for the STI. So it's just a quick summary. All right, so we have leadership at the S&P 500. All right, the new highs are supported by rare small caps and the Dow Jones transports, which I did not include the chart today. This implies that economic fundamentals are impacting the new price highs. So this is a good thing. It's not just speculation. Asian indices, well, most of them are lagging at key technical levels and are trying to play catch up. However, continued improving economic data corroborates a longer-term uptrend. Okay, so the strategy is this. Okay, well, if there's a breakage of key technical levels of specific indices, that will probably trigger a short-term cycle down. We're quite due for a cycle down. But this should be viewed as a buying opportunity, as the market actually suggests a longer-term trend. The bull market for stocks is not over yet. Intermarket and sector analysis. Okay, so once again, you have Treasuries, S&P Index, and GSI futures. So let me just say that the GSI futures is weighted 40% in crude oil, 60% in industrial metals. All right. So for bonds, we noticed that yes, there was a strong down move since the beginning of the year. All right. And right now we're in a consolidation pattern, and we want to see how this pattern is going to, where the resolution is, whether we're down, whether it's going to break downwards or have a short-term cycle up. Stocks is still on this high, and futures is still, in our view, consolidating. Drilling deeper into the daily charts, we see that yes, there is weakness on the downside still for the treasuries, even though there was a minor upswing in July. As you can see, the price for the treasuries could not get above this level, 127.066. S&P index broke out of its old high, and subsequently it's on a new high. For futures, as we thought, price did break out and it's actually kept above the support line. The first hit to the support line had a nice bounce up. So we are looking to see a resolution of this consolidation. Okay, so here's a technical trade to prepare for. Now, we believe fundamentally that bonds should be on a bear market. Now, but this can only be confirmed if this level over here at the bottom, at around 124, is broken. When this is broken here, this level is broken here, this confirms a continued downtrend. Now, if you want to play that, okay, well, if you want to play that, you can consider buying the TBT. The TBT is basically a double short treasuries ETF. It's a double short and it's a prox. So essentially buying the TBT would be, you would profit if the 10 years treasuries actually plunged on here. However, I would not do so until you see price convincingly break through this level over here. Okay. Another potential technical trade you can make, this is a slide that we showed a few weeks back. We asked you to look at this blue line. This is the OIH, which is essentially the oil sectors ETF, okay, for the NYSE. It's made out of a basket of all sector stocks. We note that because of crude oil breakout and relative strength of the OIH was turning up, we said that, well, if price breaks out this blue line and can stay above it, that implies a greater upside. So since then, yes, we have broken out in late June. We had our pullback expected to the support zone. And so now this is a great trading opportunity where if you buy this, your objective essentially is around $52 to $54. That's the objective for the breaking of this pattern here. But you can put your stop loss at this red line. If you do so, then yes, if price breaks below the red line, you would have to be stopped out. But if you do so, your win-loss ratio is 3:1, which is a favorable trade. Given encouraging macroeconomic news, this could be a possible trade to make. So to end off, based on what we've seen so far from the economic data as well as market action, we still iterate that we are around phase 4 of the business cycle, and the strategy at this point would be, for the longer term, you would like to short bonds and go long on stocks and commodities. Okay, so all right, thank you. I'm done for technical analysis, and now here's Yong Kai, who's going to talk to us about Garmin.
Hi, I'm Yong Kai here. I'm the analyst for US Securities. So today I'll just quickly go through two companies that we have covered. First one is Garmin. If you remember, we actually issued a trading buy call. That was somewhere in 12th April. Okay, so moving forward, now we have revised the trading sell. Why? Okay, so this is the second quarter earnings. As you can see that it's actually not very pretty. Overall net sales is down. The automotive mobile component, which is the biggest component of the overall net sales, is actually down 12%. Okay, gross operating net income, they are all down by at least 7%. But the market is actually reacted by giving it a 7% increase on the very day itself. So since the day that we issued a trading buy, the total return has been the 17.2%. That's because previously the market has overrated the automotive mobile because Garmin is a legacy in-car GPS manufacturer, so the market is giving it too much weight, whereas outdoor aviation, marine, they are growing anything from 5 to 16%. Okay, so now that the market has realized it, so that's why yes, the share price has increased. Moving forward, in the absence of further material announcements such as the special dividends, bear in mind again that is cash about 30% of the market cap and no debt. So if there's no special dividends and no product reviews, now might be a good time to sell into the positive sentiments. So after 17.2%, I will recommend that we long in the profit and the investors have a trading sell. Next, Genworth Financial. Previously, we also issued a trading buy at somewhere around early June. So what happened in the second quarter earnings? All operating segments are very profitable. USMI is making the profits for the second consecutive quarter. Previously, we mentioned that USMI could be a good proxy to participate in the US housing recovery, and that's true. Right now, as you can see that the management forecasts $250 million full year targets. By half of this half year, they have actually achieved $303 million of savings from this USMI. International mortgage insurance, the earnings are up sequentially and year over year, even though the US currency has strengthened over Canada and Australia. Loss ratios are at all-time low as well. Lastly, for US life insurance, they finally paid a $100 million dividend to the holding company for the first time since financial crisis. Last time we also mentioned that long-term care, they are actually trying to get regulatory approvals for premium increases, $200 to $300 million. As of first quarter, they got 60 to 65, and right now the cumulative amount is 120 to 125. So that's a very positive sign. Most of the dynamics currently are being played out. Genworth itself returned 23% just over 2 months. Yeah, and it achieved that with considerably less risk compared to its two mortgage insurer peers. MGIC returns about 25%, whereas Radian returned about 12%. So Genworth actually did this feat with a lot less risk. Target price is going to be revised upwards as its publicly traded associates as well as comparables have traded upwards since the last report. So Genworth USMI is at 491. Canada, Australia is at 3+. Okay, what we want to bring your attention to is Australia MI. So if you look at the second quarter earnings, the book value actually dropped by $400 million to $1.9 billion. But the thing is that because the publicly traded associate Canada MI is actually up around 16%. So net of our Australia MI is actually pretty much unchanged. The last report was 361, now it's 351. Okay, so if we apply the standard 20% conglomerate discount, we're going to get a fair value of $17. Our previous fair value was about $15.20. Yep. So if we look at today's market price, $13, we actually have an upside of 30% and we reiterate a trading buy for Genworth Financial. Right. So now I'll pass on to my colleague Nicholas.
Hi, dear clients, I'll be talking about Ezion Holdings today. Ezion was engaged in the mechanical engineering business before 2007 and was called Nilec Technologies before they entered the OMM industry. It started as an offshore logistics and service provider by offering support vessels to oil companies on charter. In 2008, it ventured into self-elevating units, SEU, also called lift boats, bringing the concept to Asia and the Middle East. There are two key main business segments for Ezion. Ezion's lift boats and service rigs segment provides SEUs to offshore oil and gas industry and currently has a fleet of 27 SEUs, including those under construction. For offshore logistics support services, it is involved in O&G related logistics support via a fleet of about 40 vessels, with more than 50% of its exposure in LNG projects in Australia. So what are lift boats? Lift boats are mainly used as a stable work platform to perform a range of services such as repairs and maintenance of production platforms, oil well servicing, oil intervention activities, etc. They can also reposition itself at an offshore site and move to a new location without any assistance, unlike for jackup rigs and barges. Hence, its higher efficiency and ability to work in tougher conditions made it increasingly a preferred option. Lift boats have been prevalent in North America, in particular Gulf of Mexico. While there are 250 SEUs in North America to support 3,250 plus offshore platforms, there are only 62 SEUs in Southeast Asia, the Middle East, and West Africa combined to support similar amount of platforms. Ezion is one of the first to introduce lift boats to Southeast Asia and the Middle East. We believe as oil companies outside Gulf of Mexico begin to realize the advantages of lift boats as a cost-efficient alternative for offshore service functions, the demand for lift boats in Southeast Asia and the Middle East will continue to grow going forward, hence benefiting Ezion. Ezion is an operator of SEUs, where it takes contracts from oil companies, outsources SEU construction to yachts like capo and triads, arranges financing, and then leases them out to oil companies on a day rate basis. Ezion targets a minimum of 30% ROE, 70% gearing for its SEU contracts, while the majority of its charter contracts are concentrated in Southeast Asia and Central America. It is also increasing its presence in the Middle East as well as other parts of Asia, including China, providing it exposure to different geographic locations. Assuming Ezion can achieve 30 to 40% ROE, we estimate that each SEU contract will add about 7 to 10 cents per share, which is equivalent to 3 to 4% of our valuation. With a total value of about $2.5 billion worth of charter contracts spread over an average of 3 to 5 years, this provides long-term earnings visibility to the company. Moreover, we believe the outlook for Ezion's lift boat business remains bright given the robust fundamental of SEU demand and in Southeast Asia and the Middle East as discussed earlier. We estimate that Ezion will enjoy a 68% two-year earnings CAGR driven by its expanding SEU fleet and higher growth in offshore logistics support business. As of end first quarter 2013, Ezion currently has 12 SEUs operating under long-term contracts with another 11 units kicking in for the rest of the year. 2 in 2014 and another 2 in 2015. We believe this will significantly drive Ezion's EPS over the next 2 years. As for its offshore logistics service business, Australia represents the majority of its current chartering projects, where it provides logistic vessels such as tugs and barges. We expect higher revenue for this segment as its 3 LNG projects in Australia begin work in second half of last year as well as first half of this year. Investors may be concerned with Ezion's high gearing. In fact, gearings had been increasing over the past 2 years, mainly due to its rapid expansion of its SEU fleet. As its SEU costs around $55 to $110 million depending on specification to build. This in turn translates to high capital requirement. This has also put pressure on its free cash flow generation over the past few years. However, we believe free cash flow should improve from 2014 onwards as new vessels start working and contribute free cash flow. This in turn should ease gearing going forward from 2014 as well. We value Ezion at $271 per share based on some of the parts valuation. We value Ezion's lift boat and service rig business via DCF, given the contracted rates and time periods for its SEU vessels and their known cost, as most vessels are chartered out based on bareboat basis. We believe the SEU business is well suited to a discounted cash flow model, DCF model valuation. We value the logistic business at a EBITDA multiple of 5 times. We are using this methodology due to the lower future earnings visibility of this segment. Our sum of the parts target price of 270 implies a 2015 P of 9.9 times and a PB of 2.1 times. Ezion is currently trading near its historical long-term average of 10.1 times. In conclusion, we believe that Ezion is well positioned to benefit from the robust liquid demand in Southeast Asia and the Middle East. Its high ROE business model with $2.5 billion of SEU contracts provides earnings visibility up to year 2020. Last but not least, this will translate to high earnings growth at 68% CAGR over the next 2 years. We have come to the end of our presentation. If you have further inquiries or questions, you can ask now, or you can also refer to our report published today on Ezion. Thank you. Oh, cannot hear. Oh no. Can we have a copy of the presentations slides, you mean? Right, definitely we will send to you after our presentation.
Hi, for clients of Phillip, the slides will be emailed to all the remisiers and all the dealers, so you can get it off them. We're still waiting for questions to come in. You can just type them in. Okay, we have a question here on Ezion. Hold on.
Right, there's a question asking how many SEUs are they constructing at the moment. Currently, they are constructing 15 SEUs at the moment with, as what I have mentioned earlier, with the bulk of them coming into service this year, 2 more in 2014 as well as another 2 in 2015. The manufacturers of its SEUs comes from various yards including Keppel Yard, including Tri-Yards, and some Malaysian yards as well. So basically, the yards don't have any bargaining powers with regards to the construction of its SEU. Ezion has more bargaining power in terms of construction of the SEU vessels. Competitors, right? This is a good question. With regards to competitors, allow me to show you guys. Allow me to show you guys this particular slide. As you can see, the top 10 liftboat players in the world are mostly resided in US itself. Because this is mainly because liftboats do have a higher demand over in US Gulf of Mexico, but they are slowly gaining recognition over in the rest of the world outside Gulf of Mexico. In particular, I would like to highlight these 2 companies, Ezion and Gulf Marine Services, where these 2 companies are residing outside US itself. Ezion, as you know, is based in Singapore. They have more exposure over in the Southeast Asia and Asia Pacific region market, while Gulf Marine Services, they are based in the Middle East, and they have a strong presence over the Middle East itself. So in terms of a competition in Ezion's current market, I should say they don't really have any competitors right at the moment, but due to its high ROE business model, we suspect that competitors will come in the near future, and this may eat into its market share, but currently there isn't much competitors out in the market. Right, there's another question in regards to Easion's high debt ratio as well as a higher interest rate going forward. Whereas we already we do note that this is one of the main concerns for investors. In fact, if you look at our report, we have mentioned that we have acknowledged that the possibility of high interest going forward, but then again, we have already modeled in into our valuation because, okay, currently Easion is paying about 3% interest for its SEUs, but we have modeled it at a 5% interest rate. So, okay, in times of rising interest rate going into 2014 and 2015, interest rate may increase up to 3 to 4%. 4 to 5%. So this increase in interest rate shouldn't be a concern because we have already modeled into our valuation. And in fact, even if it increase up to 5%, ROE will still will only decrease by approximately 5 to 6%, which is still a respectable high ROE percentage in our view. Our call for Easion, there's a question on what is our call on Easion and the target price. Our call on Easion is a cumulative rating, and our target price is at $271 per share. There's another question regarding is ISRA and Easion holding the same? I'm not very sure what is your question, but shareholdings. But currently, ISRA has already divested all its Easion shares earlier in the first half of this year.
Hi, we have a question on the outlook for gold and silver, and the outlook is bearish. So we would recommend selling gold into whatever strength you can get at this point. It's bouncing, it's stalling at the 50-day moving average. Now for gold, we have a fundamentally bearish outlook, which we have held actually since October last year, okay, way before the sell-off. And we actually downgraded gold to an underweight because we see that the US dollar is probably going to be on a strengthening path. This is due to two things. The first of which is that the US trade balance is actually improving because of the shale energy boom. The other thing is that because we have a positive outlook on the US economy, we believe that monetary policy will be on a tightening path, and all this is bullish for the dollar, and if it's bullish for the dollar, it's bad for gold. We have a question on what are the sectors we should look at for stocks that have not run up yet, as banks have already run up. And I think my colleague will talk about Quartz Asia, and for me, I think Bowstead is still a very good buy because it is a stock that is severely undervalued. If you look at the balance sheet, I think close to 50% of the balance sheet is properties that are held at cost and are very likely to be revalued higher because Bowstead has plans to REIT the portfolio. Okay, so there's a clear catalyst, identifiable catalyst in the company's strategy. And the company, X the industrial portfolio, is actually trading only at 5 times PE for what is very strong businesses. The refining business is engineering consulting for refining. They're only one of 4 players in the world. For the industrial property design and build, they are one of 3 turnkey players. And for the geospatial space, they have monopoly positions in Australia, Singapore, Indonesia, and Malaysia. I'll pass you on to Ken Ang right now, who will talk about Quartz.
Hi everyone. So on Quartz, we are right now still positive on Quartz. In fact, right now share price is relatively attractive, approximately at 91-92 cents. The main catalyst for Quartz would be its expansion into Indonesia. In fact, it will be opening very soon. It will be opening a mega store in Indonesia. It should be completed and up and running by 2015. Separately, they've also expanded quite aggressively. They're also going to open a mega store in Malaysia, and the growth in terms of floor space has been quite aggressive. We expect this to lead to higher revenue growth. Concerns may be on the expense side, but management is already is well aware of the need to manage expenses, and they have engaged consultants and have put in effort in trying to control costs. Another question would be on whether or not our top picks is still SGX, Keppel Corp, and Pan United. Yes, our top picks are still these 3 counters. On SGX, since we have upgraded it, since we have chosen it as our top pick, it's gone up a little bit. We continue to be positive on it as we continue to see that equities would do well. Trading activities will do well as investors continue to prefer equity over classes such as bonds. Moving forward, in recent times, trading activities has been relatively weak, so there might be some near-term volatility, but still in the long term, we still continue to see SGS as a very attractive play, given that it's able to benefit from higher trading activities.
Hi, on Pan United as a top pick, yes, we're still positive on Pan U. It's undergoing a long consolidation right now after quite a spectacular run-up. But we still think there is room to move, as there is another possible catalyst in that it may make an offer for the rest of the river port that it owns in China, which is a highly free cash generating asset. It has first right of refusal for the rest of the port from Macquarie Infrastructure Fund. The other thing is that the second half of earnings for ready-mix concrete is likely to surprise the market, as I think a lot of the contracts have been the earnings will probably be booked in the second half rather than the first half. And of course, it still enjoys a dominant position in this market, and Singapore still has an ongoing infrastructure boom, and we see that this is probably a multi-year trend as Singapore tries to close the infrastructure gap.
Hi, there's a comment on Singapore on the banking stock picks that they seem to have run up quite a bit already. So I thought I would just give my take on it. For Singapore banking counters, since we have upgraded it, yes, it's already gone up quite a bit, approximately like at least 7-8%. Moving forward, we see that prices are actually yes, we do agree that our prices have gone up quite a bit, and that our take on it right now is that there is still a little bit of upside potential compared to previously. The economy is relatively has shown a bit of strength, more strength than previously, especially for the banks, given that the potential tapering in the Fed could also potentially help to increase revenue. But however, once again, I think share price has gone up quite a bit. Upside potential would be relatively limited from here on. And also another question on what is stopping the market from surging forward convincingly. One of the concerns would be once again would be China, on whether or not how China would perform. and also that of the economy of our neighboring markets. A strong recovery in a strong showing in China would help the market to surge forward convincingly from here on.
Hi, this is a question for TA for Enzion. The question is, when do you think is a good time to accumulate Enzion shares? Well, from a technical analysis perspective, right now the price is 221. I'll say that a good price to enter in would be probably nearer to $2. That's where the 200-day moving average is, coupled with some major support lines. So I think nearer to $2 would be a good price to get in the near future. That's all I can say about Enzion. Okay, thank you. That concludes our presentation for this week. Oh wait, last question.
There's a question regarding what is your take on Seng Marine in the second half of this year. Well, we are remaining cautious on Seng Marine for the second half of this year, mainly due to the fact that they are going to recognize their second drill ship construction revenue recognition in the 4th Q of this year or the 1st Q of next year. So going forward, margins may still come under pressure. Also, they are also taking in profits from the their new Singapore yards, and this we anticipate higher costs in the initial stage due to the initial tooling costs due to the new facilities. Thank you.
Okay, thank you for attending this week's webinar, and we hope to see, that you will all attend again next week at the exact same time. Thank you.